Welcome to the weekly update, where I'll go over the action in the market for the week of January 8th through the 12th, and then we'll see how things look for the week of January 16th through the 19th. The markets will be closed on Monday in observance of Martin Luther King Jr. Day. So we have a holiday shortened week in the upcoming week. But this past week, we ended up having an up week. We got off to a pretty rough start in 2024. The S&P anyway was able to recoup those gains this past week and is now positive, only by 0.3%, but hey, it's still positive. We're still looking positive on the weekly charts. There are some things that we always want to be aware of. We're looking positive on the daily charts as well, but we're still maintaining a pretty strong intermediate term overbought condition. We're seeing some improvement when we look at growth versus value. That's starting to show some improvement, but we're still seeing a longer term negative divergence between the S&P 500 or the Dow and the transports. And that's going to take some time to play out if it in fact will start to improve. We are dealing with getting close to an all-time high with the S&P 500. We set an all-time high recently with the Dow and the NASDAQ 100. The S&P has not confirmed that yet. We tried to hit that level. We went above that level on Friday, but we ended up closing down below that level. And I'll show you some charts to point that out. Before I get started, here are some notes. I am in the process of putting out some new videos in 2024. I had one all ready to go, but it was going to be why we are starting off with such a bang in 2024. And then we ended up having a down week, so I kind of had to scrub that and go back and regroup a little bit. I'm also in the middle of preparing things for a program that I have where I have self-paced classes that you can go through. I also do videos every day. I have other things that I do include as far as, okay, here are some different strategies. These are some ideas that you can implement. And it takes me quite a bit of time to do that. I'm just one person working on this right now. Also, a PDF is available in the description below each video that I post. The pivot points are updated every day. There's pivot points that last for the whole month. I update that every day with the current candle for that particular day. The pivot points that I tend to use the most are intraday pivot points based on a 10-minute chart of the S&P 500. That seems to be quite accurate for finding support and resistance. Please know that it's on the community tab on the YouTube channel. I do have a private Facebook group, not an awful lot of activities going on there, but if you want to join and have a little back and forth, we can certainly do that. I did already post a new poll for the week, and I'll be going over the results of this most recent poll. And then I'm going through and I deleted a lot of comments that were just kind of sitting on the channel in different places. None of them really had anything to do with the daily, weekly, or intermarket analysis videos. These have more to do with the class that I posted, gosh, almost 2 years ago now. So sometimes when comments are made, I like that. Unless it's a garbage comment or it's obviously some kind of spam or something, then I delete those right away. But if you just make a statement that I really can't respond to, I can't really say, yes, I agree, or no, I don't agree. I just kind of let those sit. And then after a period of time, I end up taking those off. Also, videos are posted on Rumble. If for some reason I'm having trouble getting something on YouTube, or if I'm having trouble getting something on Rumble, go to the other site, because sometimes I do have problems uploading. And here is the link to the Rumble channel. Let's go back and talk about this past week. We were up 1.84%, so much more solid than what we saw for the first week, but we're still below average with volume. You've got a lot of apprehension out there. We're just not seeing a pickup either on an up day or a down day. We tend to be below average each day. We are positive with our technicals, but as I said, there's always some things that we want to be aware of here. And this past week, we did get a reading on inflation. We had CPI and PPI coming out. That confused the market. CPI came in a little hotter than expected, where PPI came in weaker than expected. And now the market's like, okay, what do we do now? We're not really seeing any uniformity here. We do want to keep an eye on the geopolitical concerns. There is some escalation going on in Yemen right now with the US and Great Britain doing some attacks. And that hasn't seemed to have had an impact on the market, at least yet, but we have a 3-day weekend. There are things that could impact oil or gold or the dollar, and that could eventually bleed over into the stock futures, which then bleed over into the cash session. So we just want to keep an eye on that. Our trend is still getting stronger. We're above 20 and we're above the moving average. We're coming down on the daily charts. We're still positive, but it's showing a weakening trend. We're still showing a strengthening trend on the weekly chart, and it is positive. Here is the week. The Dow was up 0.3%, the Nasdaq was up 3.1%, the S&P was up 1.8%, and the Russell 2000 small caps were pretty much unchanged. So for the week, and I have a lot of notes here, so it's a little bit smaller text than what you're used to. The stock market did close higher. So 10 out of the last 11 weeks, the stock market has been up. The S&P, it did briefly go above its all-time high close on Friday. It didn't go above the intraday high. So on my charts, it's not showing that we hit that all-time high because I base mine on the intraday high. They're basing this on the closing high, and it recovered all of the losses that we saw during the first week, and we're up 0.3% so far. The mega caps had another pretty good week. We got the Magnificent Seven or the Great Eight or the Illustrious 11, whichever group you want to come up with. They still are keeping the market a little bit stronger right now. And then the financial sector, which has been doing a lot better, but we had some earnings come out on Friday, and we had Bank of America, we had the Wells Fargo, JP Morgan, Citigroup, and then United Healthcare. That's not a bank, of course. Well, maybe it is. And Delta, they came out with their earnings, and they were pretty much met with more negative reactions. There were some banks that were up, but for the most part, the banks ended up being down. And this is like, okay, these are the big head honchos right here. And is that going to play into the earnings season that we're now coming into? And that kind of spooked the market a little bit. Also during the week, Microchip Technology, they came out with a revenue warning, and it didn't do much for their stock, basically because of a weakening economic environment. And then Boeing, which has been in the news quite a bit lately, it was down 12.6% this past week. A week ago, a 737 going out of Portland had a door blow off. You probably heard about that. And now they're like pointing their finger back at Boeing. And also Alaska Airlines is getting hit as well. And people are like, okay, what's going on here? We don't really like this. Boeing is supposed to build the best airplanes in the world. And we've had trouble with the Max. We've had trouble with the Max 9 now. Is there more coming here? And then the economic data ended up being mixed. We had CPI and weekly jobless claims. Those are showing strength. The PPI was weaker than expected. Interest rates ended up being down. We're back under that 4% level. We closed at 3.95% for the 10-year yield. And then we do have geopolitical concerns that we're keeping an eye on. The US and the UK, as I said before, they're doing airstrikes against targets, the Houthi, I guess that's how you say that, different Houthi-controlled areas in Yemen. And that's basically escalating because of what's going on in Israel. So now it's starting to broaden out a little bit. And yes, there is still a war going on between Russia and Ukraine. So you may not hear about it as much. It may not have a direct impact on the stock market, but it is impacting millions of lives. This is a chart that I've been following, and it's about 6 months out of date now. I really want to follow the blue line here. This is tracing from 1966 up to 1982. What did inflation do during that time? When I started showing this chart, we were about halfway through 2023, and we were coming down. And we're still kind of bumping lower for the most part with inflation. That's all good and well, and that's what the market is focusing on. But if you look at this chart, look at what happened after that. We just saw a real spike up. This led to the hyperinflation that we saw in the 1970s. We don't know if something like that is going to happen again this time, but it was also looking pretty good back in 76 and 77 as far as inflation, and then things went all crazy after that. So this just tells you how things can change over time. We did close at 3.95% for the 10-year yield. We're underneath that 4.02% that RenMac came out with their research and said, okay, when we're below 4.02%, interest rates don't have as much of a negative impact on corporate earnings. Looking at our poll, this is as of Friday's close, but these questions were a week ago. I say, do you feel the January effect for small caps has ended or will resume? Folks are split 50-50 saying it ended. The other 50% said that it will resume. We're kind of waiting for that. It seems to be over to this point. We're just not seeing a lot of strength. We're chopping sideways, if anything, with the small caps. The ADX charts, and this is the indicator that I use to tell us the condition of our trend. And a week ago, it was suggesting that we're seeing a weakening trend after being very strong, getting well above 40, which you rarely see. Do you feel that this will develop into a negative trend or back into a positive trend? Everybody that responded to this said that it will develop back into a positive trend. We're still kind of waiting for that to a degree, because we have overhead resistance at the all-time high. We have support now at the 20-period moving averages on the daily chart. So this really hasn't been decided yet. Then as of January 5th, the S&P's at its 20-period moving averages. Do you feel that this will provide support, or will there be further weakness? 60% said that it will provide support. 40% thought that it would bring on further weakness. So far, the support is holding. So we would go with the support answer there. The growth to value ratio, as well as the transports to Dow ratios, continue to show negative divergences. Now, we're seeing some improvement with the growth to value, but we need to see more than what we've been seeing so far. The transports to the Dow, that negative divergence, in fact, is actually getting worse. And do you feel that this has impacted recent declines? And folks were split 50-50, yes or no. Here's some Isabel Net blog charts. I update this every week. These are the forecasts for earnings going forward. And as long as we see all of these bars going up and we see this red arrow, which I put on here, going up, that justifies stock prices going up into the future. FactSet had a couple of blog posts. The first one came out on the 8th. It said the S&P financials for the fourth quarter, they were doing a preview. It says banks lead earnings decline. And so kind of watching here where the banks are actually negative, followed by consumer financials, and then it's really hard to read this. Something markets, capital markets. Okay, where the other areas end up being positive. This has been a concern, and this is why we saw some negativity come into the market on Friday, because folks are just not really happy with the bank results that have come out so far. And then the financial sector, this is what they're focusing on. They're looking at the fourth quarter of 2023. Those are the earnings reports that are starting to come out, and we're down 3.1% as far as growth. Then later on Friday, they said, are more S&P 500 companies issuing negative earnings per share guidance than the average? The answer is yes. And here is a chart to show you over here where we're at right now, where it is coming down based on their guidance looking out into the future. So there's some negative earnings news that's been starting to hit the market, and that's why we're seeing a little bit of pressure, even though we did have an up week. Looking at our charts, here is the chart for the whole week, where on Monday we had a pretty solid up day. On Tuesday, we gapped lower, but then we're able to get that back. We were flat later in the day. And then on Wednesday, we saw things really go up in a more positive way. This was more of a systematic rise. And then Thursday, that's when CPI came out, and we gapped higher because the first reaction was negative, that the headline number was stronger than expected. Or if you look at the core CPI, that was weaker than expected. The market initially had a negative reaction, then it rethought about things, then it ended up being positive. Well, we ended up setting the high in Thursday's session right at the open, and then we came down. But to the market's positive side here, we did spend a lot of the rest of the day coming back up, and we ended up repairing a lot of those losses. We were down just fractionally in Thursday's session. And then when PPI came out, we also gapped up higher again and then came back down, chopped more or less sideways, and ended up finishing just slightly positive. So here is the 5 trading days for the week, how we looked as far as the indexes, with the NASDAQ 100, the NASDAQ, and the S&P being positive, with the Dow, NYSE, mid caps, and small caps all being negative. Now I'm going back to the beginning of 2024, so there's only 9 trading days of data in this. This will get longer as we go throughout the year. where we have the NASDAQ 100, the NASDAQ, and the S&P are positive, where the other indexes are still underwater. And then we're still going back to the all-time high to measure things. That's until we set a new all-time high with the S&P 500 on a closing basis, where the NASDAQ 100 is now up, and the Dow, they have set recent all-time highs. We're waiting for the S&P to come join the party. It's not quite there yet. The other indexes are still underwater. Looking at our different sectors, we had an up week with the tech sector being up the strongest, followed by communication. These are the growth areas. This is why we're seeing more improvements when we look at our growth to value ratio. Staples, which is more of a defensive play, but it just got hammered in 2022. It actually ended up being up. And then the areas that were down with financial sector for the week because of the bank earnings that came out on Friday, materials, utilities, and energy. They ended up being negative on the week. Looking at our relative rotation graph, where we're just seeing energy really fall off. That's XLE, where it had been really strong during different periods in 2023. It's now one of the weaker areas. And we're seeing some improvement here with XLK, which is tech, XLF, which is financials, even though it had a bad day on Friday. And then real estate is showing some improvement. As interest rates have been coming down, that helps the real estate sector. We are seeing some improvement in other areas where we're also seeing a little bit of weakness continue both with the healthcare sector and the materials sector in here as well. Then looking at the different sectors, this is just for the 5 trading days where we had tech, communication being up. All of the other sectors were down. Going back to the beginning of the year, just the 9 days so far, tech, communication, and healthcare are positive. The other sectors are negative. Going back to the all-time high set in early January 2022, energy, even though it's given up a lot of its gains, it's still doing very well in the bigger picture. And tech, industrials, and healthcare are positive. The other sectors are negative. Looking at sentiment, we did get up above the 75 level. And now when we do that, we're looking to use this as a contrarian indicator. That just means the party's going on a little too long. So when we look at the historical chart, we came up here back in December and we're getting extreme positive and then came down. Now we just barely got up to that 75 level again, and we're starting to come back down. We don't know. Is this worn off enough to warrant going back up, or are we going to see some kind of a change in sentiment? Here's the active asset managers. They had been extreme positive, fell back. They showed a little bit of improvement in the latest reading. Here's another look at that same chart where we're coming in at 80.81. This is still a pretty high reading when we compare it with other readings, so they're pretty optimistic. And then we look at the VIX, which continues to give us very low readings, both on the line chart as well as the bar chart. You can see we're way down here near the lower end of the VIX range. The Ulcer Index is also showing that there's not a lot of fear in the market. We're seeing that pretty much in the daily charts. And folks are still tending to be more positive when we look at the RIDEX bear to bull ratio. When this goes up, folks are negative. When this goes down, folks are positive. So it's opposite of what you might think. The latest reading of American Association of Individual Investors didn't really show a change. They're positive on things, and we watched the red line here, and that's going up and actually crossed above 0, but they're not necessarily extreme positive at this time. We look at 1 to 3 month T-bills, which is cash, and compare it with the tech sector. When this black line is going down, that means the tech sector is outperforming cash. It didn't outperform in 2022, but now in 2023 and so far in 2024, it is outperforming. Keeping an eye on some economic gauges that we follow, this is the latest reading of GDP now, just an estimate put out by the Atlanta Fed, where they're coming in about 2.25% or so for GDP. When we look at the forecast, it goes up to about 2.5% to the upside and about a little under 1%, maybe 0.75% to the downside. Here's what it looks like in bar format, where now we're starting to focus more on the fourth quarter of 2023 for GDP. Then looking at the spread between risky and not as risky bonds, this ratio continues to go down, or the correlation is going down, but this is also going down. It's when this really starts to go up, that's when we get nervous. The fact that it's going down is pretty positive for the market. We also look at the Chicago Financial Conditions Index. This is continuing to decline. We get nervous when we go above the black line. The domestic banks, this hasn't been updated since November. My gosh, this is long term. So it's almost useless. And then the real-time SOM rural recession indicator, this was updated on the 5th of January. We've come up a little bit and it's starting to come back down, but we're still below the red line. When we get nervous is when we go above that red line. And then the smooth recession probabilities also coming up a little bit off the black line, but well below the red line. And then looking at the Brave Butters Kelly leading index, this was updated at the end of December, where it had been coming up and it's now starting to come back down. This was causing a little bit of concern, but we haven't had a recent update with this. Keeping an eye on inflation, we started a new quarter at the beginning of the year, so we don't have a lot of data here. This adjusts every day, and it just talks about or shows us what the CPI and PCE inflation outlook currently is, and we're not seeing any real big changes there. Here's what everybody seems to be fixated on right now. This was as of the close on Friday. There's a 94.8% chance that they're going to leave rates unchanged at their next meeting on January 31st. The market isn't even pricing in any kind of a rate cut. They're looking out to March for right now. So January, it's pretty much, according to the market, a done deal that rates are going to be unchanged. And here's how we see that this is getting more convincing right now to the market, or the dark blue area, that's the current reading, than a day ago, a week ago, and a month ago. Now we look out to the March 20th meeting, where currently, as of Friday's close, there's a 76.9% chance that they're going to cut rates 0.25%. Now, this is going to change a lot between now and then. And this could really go down if we get stronger than expected economic reports. This could go back up even higher than it is now if we get weaker than expected economic reports. That's why we pay attention to this. And this is the change, where they're pretty much convinced that we're going to be down 0.25%. That's what they were a day ago. It's up from a week ago and a month ago. Looking at the Fed balance sheet, it's continuing to decline, just like they said. That started in June of 2022, and this is the year-over-year change as things are falling off the Fed balance sheet. Keeping an eye on the advanced decline line, we're still looking positive based on price and volume. We're above the moving average, so that is looking good. The new highs, new lows, we're pretty much at the top of the scale here, so we're pegged out here with our 4-week moving average. We're showing that same thing on the daily chart, but we are declining with the 10-week moving average, and we're seeing that on the daily chart also. That's because we're seeing there's more new highs than new lows, but they are falling off, although we did see some new highs picked up this past week. Looking at the advanced decline ratio, we're still above 0, so that is positive. Accumulation distribution continues to be positive, and we're also positive on the daily chart. This is a smart money indicator. Here's our trend. We're above 20 with the ADX, and we're above the moving average. This is suggesting on a longer term basis, we are still trending. We're on the daily charts. We're below the moving average, showing that, yeah, we're trending, but it's a weakening trend. The green line is on top, so that means that we are positive with the trend. Looking at the Arun indicator, we're above 0 and advancing. That's positive. We're getting extreme positive on the daily chart. The mass index is not generating a signal. Looking at the daily chart, where this is the line I was talking about, we have this gold or yellow line here. I've drawn this from the intraday high that we set back in January 2022. So that's why we didn't hit it in Friday's session. They're basing this on the close that we set back in January of 2022. So we still have a ways to go right now. On the bottom, you can see for all of the days, there was one day that was above average, but all the other days are below average with volume. We're still above the midpoint with our trend channel going back to 2009. That's positive. And we're still above this pivot level on the weekly chart. We ran into this area back in July of 2023, and then that's when we started to hit some problems. We're still above that level now. If we do see some kind of a decline, we'll be watching this level to see if it offers support now. We're still in an uptrend with our 50-week moving average, and our other long-term trend analysis shows that the S&P is in an uptrend. We're actually declining with the McClellan oscillator, and we're seeing this on the daily charts too. And this is a little bit of a warning sign for us. We're below 0 and declining. So when we look at the summation index, we're coming off of a really extreme positive reading, but we're still extreme even though it's declining. We're also turned down and no longer extreme based on volume, but we're still above zero, where we're turning more negative on the daily charts. Just something to be aware of there. The Swenlin trading oscillator, we crossed back above zero based on price. We're improving, but we're still below zero based on volume. Here's the bullish percent index, and we see pretty much the same chart on the daily version where we hit a really high reading. We're starting to come down, but we haven't crossed below 70. We're still positive, but we are extreme positive. And then looking at our momentum oscillators, we're positive based on price and volume, even though we've been coming down with the individual studies here. The PMO itself continues to go up. And we're also seeing a negative divergence that we're seeing on the daily charts as well as the weekly charts here, where the percent of PMOs that are rising, as the S&P was going up, this was going down. The buy signals, as the S&P was going up, this was going down. And we're still extreme positive with the percent of PMOs that are above zero. We're seeing that same reading on the daily version. The percent B, we have not come up to the upper side or lower side of the Bollinger Band right now. We're above the midpoint, so that means we're positive. And here is looking at momentum, where we're rolling over the moving averages and turning more negative. In fact, I have a chart to show you later. We're still looking positive longer term with the slope and TSI. These are our short-term oscillators. The intermediate term is the MACD, the PMO, and the PPO. They're still looking okay. And our long-term oscillators, the TRIX and KST, they're still positive in the long term. Some of these are giving us kind of an extreme positive rating, like the slope, and down here at the bottom, the KST, and even the TRIX. So that is a warning sign, but we have to go with the momentum. Chaikin money flow, showing some improvement on the weekly chart. We're seeing a little bit of a negative divergence on the daily chart, where the Chaikin money flow is actually coming down. It's still positive, but it's not showing an awful lot of strength. The Chaikin oscillator is coming down and no longer extreme positive. The force index is going back up for the past week and is positive. We're extreme positive with the money flow indicator on the weekly chart. The rate of change, we had an up week, so we were positive there. Going back 50 weeks, we're coming down after getting into what could be said is extreme positive territory, but we can go well above that at certain times. The relative strength index, based on 14 weeks, we're above 50 and advancing. That's positive. The weekly special K chart is still negative, where the daily special K chart is positive. The Stochh RSI is still extreme positive. Williams percent R. We're seeing this on the daily chart and now the weekly chart, where they're both extreme positive. The ultimate oscillator, after giving us an extreme positive reading, is now dropping back down. The vortex continues to be positive. We could be coming up into this one line here. Where we really get nervous is when we go all the way up to the red line. So for right now, this is still positive. The Copic curve is positive, where we're negative on the daily chart. And we're not really hitting anything other than this previous high point here for the S&P. We mainly watch this chart for different support levels when the market is under pressure. Our different charts, we are positive with the Heikin Ashi, we're positive with the Kagi chart, positive with the Renko chart, and positive with the three-line break. And we're seeing things improve quite a bit on the daily charts with our different chart variations. We're positive with the ease of movement. We're above zero and advancing. We're seeing that same thing on the daily chart. Nothing new was drawn. We didn't see enough of a movement here to generate a new X or an O for this past week. The last signal was generated on November 20th. That was a double top breakout. We are still neutral when we look at the Elder's Impulse system. We haven't had enough of a move up yet for that to turn positive. And we continue to be positive with the weekly chart of the parabolic SAR. That was a big thing that happened this past week. We saw the daily chart go from negative back over to positive. Here's the momentum for the PPO long-term. We're positive. We're pretty much flat in the intermediate term. We're showing a little bit of an improvement in the short term. And then here's some daily charts. And this is what I show. I'm probably not going to show this in the daily video unless there's a change, because I go through this and it's like I'm saying the same thing every day. And I know I do that enough with other charts, but this isn't my work. This is put out by decisionpoint.com. They're also a contributor to stockcharts.com. And they have a couple of different models. In the short term, midterm, which I call intermediate term, and long term, they're positive with their trend models, and they have been here for a while. The PMO signals, and Carl Swenlin developed the PMO. He founded decisionpoint.com, and now he's a contributor, and his daughter is also a contributor to stockcharts.com, where they continue to be negative. And that was generated right at the beginning of the year, where in the intermediate term, we're positive. Long term, we continue to be negative and have been negative since April of 2022. This is what I've been watching on the daily charts. We have the 20-period moving average, which is the first line in the sand of defense when we've been going up and start to pull back. So far, both the exponential and simple moving averages have held, and we're still above them for right now. If we see further weakness, we'll be watching this. If we drop below this, the next logical line would be the 50-period moving averages. And here's the parabolic SCR, where we had gone negative on the daily chart. We ended up switching back to positive on the daily chart now. And here are the momentum oscillators for the slope TSI, that's short term, where they're turning back up. They're trying to show some improvement, but they're still below their moving averages. We're flat with the MACD, we're flat with the PMO, and we're flat with the PPO. They're trying to decide, do they want to turn back up, or are they going to continue to go down, where we continue to decline with TRIX and the KST. These are our longer term oscillators. And this is another negative divergence where the Dow is really near all-time highs. The transports haven't even been able to get back to this previous high, let alone set an all-time high. I'm not really as focused on utilities right now. It's mainly between Dow and the transports that has been a bit of a concern. Looking at seasonality, we are in the month of January, where if you take 2020 through 2024, we're up 40% of the time, and we're flat as far as a return. Looking at just a plain vanilla chart of the S&P, which is very close to its all-time high, the mid caps still have a further ways to go here, and the small caps even have a little bit further to go. The Dow continues to be in an uptrend, and even though it was down in Friday's session, it was up on the week and is still looking pretty strong. The NASDAQ is still in a longer-term uptrend. So is the NASDAQ 100. Here's another weekly chart of the QQQs. We're getting ever so close. If we could close up a little bit, we would set another new all-time high with the Qs. The mid-caps are just generating a recent golden cross on the weekly chart, even though they've been seeing some weakness. And that's been the frustration with the small caps and the mid-caps. They break out and then give a lot of that back. So... and here is the small caps. Breakout, give a lot of it back, but they're also generating a longer-term golden cross. The NYSE, which is a broader market measure, continues to be positive. All stocks, which looks at stocks in the U.S. and outside of the U.S., this is still positive and getting really close to this all-time high again. The 30 biggest software companies, they were showing some improvement and then started to fall back. Now they showed a little bit of an improvement this past week. So they're just kind of in a barely a longer term uptrend. The FANG index is still looking pretty solid. We did set a new intra-week high, all-time high, but we haven't necessarily set a new closing all-time high recently. ARK is still kind of fighting back a little bit in 2024 after going into a longer term uptrend. And here are the banks where we're starting to come down after being extreme positive with the RSI. We did see things really move up and show a lot of improvement, but now we're chopping sideways, and a momentum on the weekly chart continues to be positive longer term. Looking at the deposits, we're still seeing money going out of banks when you compare inflows with outflows. And looking at just a plain vanilla chart of Dow theory with a weekly chart where the Dow is near its all-time high, we have quite a ways to go with the transports and even further to go with the utilities. The CRB index just getting ready to generate a death cross here. They had been stronger in 2023. Now they're starting to show more weakness as inflation seems to be under control, at least for right now. Oil still bouncing around the 72 level. Copper still deciding if it wants to go up and suggest that the economy is getting better, or go down, suggesting that the economy is getting worse. So the longer term, it's still trying to decide what it wants to do. The dollar did bounce back up this week, which gave a little bit of pressure to stocks, but still we're starting to see a longer term death cross here with the dollar, but we're still above the 100 level. Gold is still in a longer term uptrend, but it's just not breaking out above these previous highs, at least when we look at the gold ETF. And silver isn't even very close right now. It's trying to generate a golden cross here with its trend, but it has quite a ways to go to get back to up to the all-time highs, or that breakout price, I should say. Keeping an eye on bonds, where we're showing a lot of improvement with bonds based on price, not only on the daily charts, but also on the weekly charts. Here's a monthly chart showing that stocks are now back to outperforming bonds on a longer term basis. And we're still watching this. I stopped showing this in the daily video because we're just like, it's positive, it's positive. It should be negative. When you take the 1 month yield and subtract the 3 month yield, you should always get a negative result. And for quite a while now, we've been getting a positive result. And I'm wondering, is that some kind of a warning sign? Because usually when these things happen, something freaky is happening that maybe we don't know about at the time, but we find out later on. And here the market was telling us the whole time. Looking at yields, where we are declining overall when we look at all the different maturities. Here's a weekly chart with the US and UK having the highest rates, followed by German rates, which did go up this past week. Japanese rates continue to decline. And then this is a chart which you could read something into this, or it may be nothing. Anytime we spike with the 10-year yield, and then something bad happens after that. Spike, bad, spike, bad. Where there's other times we did spike, and we don't know if this is a spike. Is it going to go back up and then come down? Is there something that's going to happen here that we don't know about yet, that we're really not being told, that the market may be anticipating? They know something is not quite right, but they're not quite sure what it is. So we're just waiting to see what that might be. Our relative studies, and here's the new chart for 2024, where so far we have oil up since the beginning of the year, followed by the dollar and stocks, where gold is negative on the year and bonds are also negative on the year. Here's going back to the beginning of 2022, where oil is still doing the best, followed by the dollar, then gold, then stocks, where bonds are still underwater. We look at some ratios between the NASDAQ 100 and the S&P. The NASDAQ 100 is outperforming. Now, both of them are right near all-time highs. So the fact that this is going up shows that the NASDAQ 100 is still outperforming. The S&P 100, I was bringing this up in some of the videos. We were seeing some weakness. We seem to be seeing things getting a little bit better now with this ratio when we look at the S&P 100 and compare it with the rest of the S&P 500. The growth to value ratio is coming back up, but it had been showing more of a trend down. We want to know, can this continue? And if it does continue, that would be more positive for the market. The gold to S&P 500 ratio just shows that gold is underperforming the S&P. Gold came right up to this blue trend line here and is now starting to come back down when we measure it against the dollar on a ratio. This still shows that bonds are underperforming stocks longer term. Low volatility did spike up when we had the down week. Now it ended up going back down as we had a positive week. Discretionary to staples. This is another area of concern. We're not really seeing discretionary outperforming shorter term. And now that's starting to affect the longer term chart here. If this really continues to fall, that would be a concern to us. Right now, we're just making note of that. And energy is really underperforming the tech sector. Then looking at some of our longer term setups and positive scenarios here, we did set the low, it looks like now in October of 2022, and then we've seen a good breadth thrust up off of that. So that is a longer term signal that's on the books indefinitely. We saw two ZWAG NYSE breadth thrust signals generated within the last year. Just to see one is very rare, let alone two. And this is also indefinitely on the books and is long-term positive. The Zohorchak, and I didn't bring up the correct chart. We're still at zero here. We had dropped down to -6, and now we've bounced back up to neutral. Here's a long-term chart going back to the 1987 crash. We're still right on this trend line. I know there's a lot of perma bears out there that they've just been salivating and saying, oh, we're hitting this long-term resistance, man. Everything's going to fall apart. Blah, 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 blah. Well, we've been watching this now for about 6 months, and it hasn't happened yet. But it still could. Here's a more of a shorter-term look at that same chart where we're still above this longer-term trend line. Then this is another newer indicator that I've been showing in the daily videos, and I think I'm probably just going to show it in the weekly video unless we see some kind of a change. Up on top is the S&P, and that's what I'm mostly focused on. Down below is the new highs minus the new lows. And then we measure this using a 50-period exponential moving average. And for most of 2022, and even a lot of 2023, we were down below zero here. Well, now we're starting to come back up above zero. And if this can stay up here, this is a longer term indicator. The longer this can stay up here, the more positive that will be for the market. And then here's looking at the NASDAQ 100. We're right about on the longer term trend line. So nothing has really fallen apart yet. We look at a NASDAQ 100 to Dow ratio on a weekly chart. We're still hanging out right near these recent highs. It's not looking like a real blow off top at this point. Here are the Qs to the small cap IWM ETF, where we were coming back down, but now we're seeing some more strength in the Qs, and so this ratio is starting to go back up. And then we're keeping an eye on the NASDAQ 100 new highs, new lows, the cumulative reading. It's finally starting to turn back up, so that's somewhat positive, and we're just barely above zero when we look at the new highs minus the new lows. That could be longer term positive. If this could turn and sustain more of an uptrend, because it's been going down for years now, that could be longer term positive. We look at the 3-month yield. We're above where we were at back in 2007, and then we had the great financial crisis after that. Well, we've exceeded that yield, and now we started to come back down, but now it's kind of starting to go back up again. We don't know if this is a warning sign or not. We just want to keep an eye on this. Then this is just for Tuesday's session. So what's the outlook? The markets will be closed on Monday for Martin Luther King Jr., the holiday. Is the January effect over? Right now, it looks like it's DOA, but it could kick back into gear at any time. Right now, we have a trifecta score of 0 for 2 because the Santa Claus rally was negative. The first 5 days of January were negative. We're waiting for the third score to see what does January itself do. If it's positive, we'll be 1 for 2. If it's negative, we'll be 0 for 3. Then the technicals are positive, and right now we're between or above the 20-period moving averages, but below the all-time high that is acting as resistance. We will get the New York Empire State Manufacturing Index in Tuesday's session. That's really big as it applies to New York, but it doesn't really have a big impact on the whole market. And then we want to keep an eye on all the different geopolitical events. Right now, it's what's going on in Yemen. Here's the upcoming calendar based on the economic reports. We're closed on Monday. Then we're going to get retail sales on Wednesday and industrial production as well as capacity utilization on Wednesday. The other big one that I think is going to be Friday when consumer sentiment comes out. Then looking at seasonality, just for January 16th, we're neutral to negative with the Dow and the NASDAQ, where we're neutral to positive with the S&P. We will be in options expiration week, and we tend to be down 47 or up 47.6% of the time and down 52.4% of the time. So statistically, we're a little more negative than positive. Then this is the Carson chart that we've been watching, where election years tend to be weak early and then rally late. Well, we're in this yellow area for right now, and that's pretty much what has been happening so far. We will be on the 10th trading day of the month on Tuesday, where we do see a little bit of positive seasonality when we look at the green dashed line. That's the S&P during an election year. And we're wondering, where are we, if anywhere, in this January effect? This is what historically happens. Yeah, there's some pullbacks here and there, but is it going to resume? Is it over? Is it going to go to the moon? We're not really quite sure right now. And then this also confirms what we were seeing on the other chart, where during an election year, we tend to start out more choppy. If we see strength, it tends to be later in the year. And we're also seeing that with the Stock Traders Almanac, where we're pretty much flat to begin the year. And then during an election year, when the sitting president's running for re-election, we don't know if that's really going to happen. Of course, that's what they say is going to happen, but then there's all these other scenarios coming out that maybe it may not run that way. So when the sitting president does run, we typically would see more positive seasonality than what we've been seeing right now. And then we'll be on Tuesday's session, where we tend to be down more than up in 2023. This is another chart that's only in the weekly video now. There was a period of time when we were looking at 1982 and then what happened after. it looked very similar to what was happening in 2023. And we're wondering, are we going to see continued strength going forward? And we're not going to know that until we look back on this in the future. And then we're up and down 50% of the time for the S&P when we look at election years going back to 1950. The scenarios that we're going with now, we're not going with the down scenario because we're still positive on our charts. We are overbought. We're below resistance, but we're above support. But most of our charts are still pointing up on the daily charts. But so that's really what we go with. But at the same time, we are dealing with an overbought situation. We're no longer dealing with a problem with the sideways trend because the ADX charts are both dropping below 40. That was an extreme reading that we rarely see. So the warning signs, growth is showing weakness, but it is starting to bounce. Is there some improvement starting to happen? We need to see follow through with that. The risk on posture is showing weakness on the daily charts. It'd be nice if that was really going higher too, but it's not really going up right now. The equity put call ratio, we saw the equity put call ratio daily chart just spike up before Thursday's release of the CPI report. And then it came back down on Friday, but then we were kind of down a little bit ahead of a 3-day weekend. So it spiked up a little bit more, or it came down and then blipped back up slightly in Friday's session. Was this just hedging ahead of the inflation report coming out? We don't really know. But what that's done is it's kicked our 5 period in back to going up where it had been going down. And it's kicked us into an extreme reading right now. That could end up being positive for the market because once we top out with that and start to come down, that could give support to stocks. The transports continue to negatively diverge from the Dow. The 1 to 3 month short-term bond spread, that continues to be positive. And I showed you that chart. The Copy curve is negative. Our oscillators on the daily charts, they're below their moving averages, but some of them are still extreme positive. So we're getting kind of mixed signals there. We're seeing some improvement with the NASDAQ 100 momentum oscillator that we follow, but it's still negative. Long-term, the long-term trend lines that I showed you, we're still wondering, is that signaling some kind of a top? It's been playing out that way for about 6 months now, and nothing has really been decided. The 3-month yield is above where we were back in 2007. We don't know if that means anything right now or not. Earnings season can be either positive or negative. It was negative on Friday. Who knows? We could come back this upcoming week and it could be wonderful. Then looking at the positive signs, our daily special K chart is positive. Our weekly chart is negative. The longer term equity put call ratio, it's going down, but even in the 253 period, it ticked back up with that massive spike that we saw in the 1-day equity put call ratio. The parabolic SAR chart is now turned back positive. The bullish percent index is still extreme for the S&P, but it is coming down. The vortex is positive. The Zohorchak is neutral. We're still dealing with longer term uptrends. When we look at the Russell, the small caps, and the mid caps, they generated recent golden crosses. Small and mid cap growth, it's chopping sideways, but it's still positive. The financial sector is still positive, even though it got hit a bit on Friday. And our new high, new low study based on 50 periods for the S&P, it continues to be positive, even though it has been declining lately. Long-term signs, we have seen multiple ZWAG NYSE breadth thrust buy signals that were generated within the last year. The cumulative new highs, new lows for the NASDAQ are showing some improvement. They're starting to turn back up. Can that continue? The new highs, new lows, that newer chart that I showed you, that is above 0. And seasonally and historically, January ends up being flat a lot to slightly positive during an election year. So we don't really have a real slant on that. Longer term positive seasonality and setups remain. Those cover the charts that I went through that I usually don't show other than in this video. So our conclusion for the daily analysis that we applies just to Tuesday, we're positive still, and we're between the 20 period moving average and the all-time high. That's what we're looking at in the short term. We're still dealing with an overbought situation in the intermediate term. We still have somewhat of an overbought situation in the long term because we have a 150 and 200 period moving average that is still extreme positive and is really not showing signs of coming down, at least yet. Thank you. I really hope you found this helpful. Please feel free to check out the daily videos that I also post. After this, I will be recording and uploading the intermarket analysis video, as well as the deep dive video where I go through a lot of different charts that I really didn't cover this past week. Have a great weekend. Enjoy your holiday, and I will talk to you in the next video.